We've got the NBFC issue, and we've also got the PSU bank recapitalization issue. The way that the analysts are interpreting it is, yes, there is good news in that more capital has been provided. However, it looks like it's close to the minimum requirement rather than being a sum of money that resolves the issue for the longer term. So I think we will continue to be discussing issues with non-bank finance companies. We'll be continuing to discuss issues with undercapitalized PSU banks. Now, we have had some change in the regulations, as I understand them, particularly of housing finance companies. I think the market will probably treat that as a positive thing in that the regulation maybe gets more robust, more homogeneous across the different types of institutions. And that's probably a good long-term fundamental news story for India. Now, with regards to the Indian economy and consumption and business investment, I don't see there's any near-term positive drivers for consumption. The Indian consumer isn't overly sensitive to interest rates. There are other factors that can be more dominant within the Indian economy. Now, some of the things that came out of the budget may increase the propensity of countries or global organizations to invest in factories in India and other services. And that might, in the longer term, help consumption, but nothing that's really going to have an impact over the next quarter. I think that the near-term outlook for flows is going to be quite poor. We are seeing a correction in global equities after a strong performance. We have had a rapid decline in bond yields for much of the year to a level where you ended up with a funny shape in the yield curve. As the investment community pays more attention to the US economic data, which remains very robust, as was demonstrated in those employment numbers, which are undoubtedly some of the most important numbers you should ever look at in an economy, particularly a consumption-driven economy, then the outlook to me is higher bond yields, maybe a more normalization in where bond yields are. And if that's the case, then you're going to get some broader pressure on credit markets, including emerging market credit markets. So I would be cautious on flows